So aside from paying your CGT on the sale of real property, you should also pay your documentary stamp tax because generally in a sale of real property, it is evidenced by a document. It is evidenced by a document. And since it is evidenced by a document, it will be subject to tax. So what is the tax? The tax is 15 pesos for every 1,000. 15 pesos for every 1,000 or 1.5%. So for example, our selling price is 7 million. The fair market value is 4 million. The cost is 5 million. So the higher between the selling price or the fair market value, that is 7 million or 4 million, our tax base is 7 million. You multiply to 1.5%, that is your DST. So 7 million multiplied by 0.015, your DST is 105,000. So your form here is BIR form 2000 OT, and you must pay within 5 days after the close of the month. Okay, so for example, the sale was made on June or January 10. The sale was made on January 10. When is the due date for the CGT and the DST? CGT, we said 30 days. So ilan pa natitira sa January? 21 plus 9, 30. Therefore, our due date will be on February 9. How about for our DST? For our DST, we said it is due 5 days from the close of the month. So kung January 31 ang close ng month natin plus 5 days, your answer should be February 5. February 5. Okay? Ulitin ko lang ha. Ang due date ng CGT ay 30 days from the date of sale. Ang due date ng DST ay 5 days after the close of the month. So if ever 5 days yan, ang sagot natin ay Feb 5. Feb 5. Okay. Now, since we're done with the CGT of a real property, let's go now to the CGT of stocks. Okay? So CGT on stock directly to buyer. CGT on stock directly to buyer. So what is subject to your CGT on stock directly to buyer? Only on the gains that have been realized by the seller from the sale, exchange, or other disposition of stock. So whenever we say other disposition of stock, this include your pacto de retro sale and your conditional sale. Take note, only stock directly to buyer. Now, let's look into the exceptions. The first exception is exchange for services. Okay, so you provided a stock in exchange for a service. This is not considered subject to income tax. Why? Here, there is no gain. There is no gain. It is more of an expense. It is more of an expense. So not an income, but an expense through a service, therefore, not subject to CGT on stock. Next, gratuitous transfer. Gratuitous transfer is also not subject to income tax. Why? Because this is either subject to donors or estate tax. You already know you need to determine the transaction, whether it is gratuitous or onerous. We said we can only tax an income if ever it is onerous. This one is gratuitous. Therefore, there's no income. Next, on the issuance of stock. So for example, you issue stock to get financing. So if you still remember, asset is equal to liabilities plus equity. What increases your asset is any issuance of share. So if the issuance of share is through a financing mode, so it is not considered an income, but merely on financing. So if the issuance is not a sale, but more of financing, then it is considered as not subject to income tax. Next, receipt of liquidating dividend. We said this is subject to RIT, either capital gain or loss. So the liquidating dividend less the cost of investment. Okay, I said that a while back already. Next, we have your redemption of stock or buyback shares. For buyback shares, if that is purely for cancellation, purely for cancellation, there is a uh purely for cancellation, there is a gain or loss. It's still subject to RIT. But what if it is not for cancellation? It is not for cancellation. If that is domestic, then can be subject to CGT. But if foreign, then it is considered subject to RIT. So in your redemption of stock, as a rule, if that is purely cancellation, you now look into the gain or loss. It is more of a liquidating dividend. It's like a liquidation of that stock. But if it's not for cancellation, if that is a sale directly, so domestic, CGT, foreign, RIT. Just remember, any stock directly to buyer as a rule is subject to CGT. Now, let's look into the CGT on stock directly to buyer. On your CGT on stock directly to buyer, we have here, again, we said it is based on your net gain. The only CGT subject to presumed gain is your CGT on the sale of real property. All others, ang ginagawa natin, net gain. So first, let's determine our net gain. To get for a net gain, that is equal to your selling price, less cost, less selling expenses, less DST. What is the cost? The cost, normally, you know this one as your tax basis. So what is the tax basis? If that is through a purchase, if that is through the purchase, you can use a specific identification, FIFO, or average. If ever that is through a device or an inheritance, so you receive a stock through an inheritance. If that is an inheritance, you get the fair value at time of death. If that is a stock coming from a gift, if coming from a gift, you get the lower fair value at the date of gift or at the time it is in the hands of the donors or anyone who held it before, not through donation. And if ever that is a tax-free exchange, what is a tax-free exchange again? That is either through corporate reorganization or acquisition of control. If that is either corporate reorganization or acquisition of control, you look into the amount of your shares exchange or shares received. At the same time, look into the rule of share swap with non-cash. Okay? Share swap with non-cash. So if ever that is tax-free exchange, normally whatever is exchanged, that is equal to the amount of the shares or the cost of our tax base. So the tax base is on our cost depending on purchase, device, gift, or tax-free exchange. How about if ever inadequate consideration? If from inadequate consideration, whatever is the amount paid, that is really a purchase itself. Now, for selling expenses, any selling expenses on the sale of your stock directly to buyer and your DST. Your DST depends whether since this is a stock directly to buyer, your DST would be 1.5 over 200 of the par value. Later, we will discuss more on the DST of your stock directly to buyer. Now, our tax rate here is 15%. Before, during train law, we still determine whether it is foreign, corporation, or not. But now, with the invent of your create law, tinanggal yung sa foreign corporation, purely it is now 15%. Now, what is the tax due? The tax due is either transactional or annual. What do we mean by transactional? Each transaction we need to file. And then we also need to get for the annualized tax. Annualized tax. Okay. Furthermore, you can also have installment for the reporting of your tax due. What is installment seal here? If initial payments is less than or equal to 25%, then you can pay an installment. But take note, for installment sale of stock directly to buyer, the selling price must be more than 1K. For real property, walang ganyan. Hindi mo tinitignan yung selling price. So, sa stock, may tinitingnan nga pang selling price at initial payments. Sa real property, purely initial payments lang po yung titignan natin. Okay? So, tax base, sorry, multiplied by tax rate will give you your tax due. So, let's go to special rules on your tax. We have here your wash sales rule. So what is this wash sales rule? It is deemed to occur when within 30 days before and 30 days after the losing sale of securities, the taxpayer entered into a contract or option to acquire the same or substantially identical shares. We don't need same shares as long as identical yung shares niya. Take note, either contract or option. But look into the losing sale. What is a losing sale? So let's say, for example, we purchase 10,000 shares for 10 pesos each. 10,000 shares for 10 pesos each, 100,000 on January 1. On January 15, you sold the 10,000 shares for 7 pesos each. That is only 70K. So in short, this is a losing sale. Sir, why is it a losing sale? Because the selling price is 70, but the cost is 100. So there's a loss of 30,000. There's a loss of 30,000. So that is a losing sale. If that is a losing sale, you need to look 30 days before and 30 days after. Okay? 30 days before, 30 days after. Sir, what is the rule on that loss? So you already know that there's a losing sale, right? The loss shall not be deductible in full if there is a wash sale. So you need to look if there is a wash sale. So for example, here, we purchased January 1, right? 10,000 shares for 10 pesos, 100K. We sold on January 15 the 10,000 shares for 70K. You need to look if there is a wash sale. What is the wash sale? Any purchase of the wash sale is a purchase of the same share within the 30 days before or 30 days after. So this is the purchase within 30 days before or 30 days after. Okay? 30 days before or 30 days after. So assuming on January 20, we purchase additional shares, 15,000 shares for 8 pesos. 15,000 shares for 8 pesos. So that will give us 120K. So this is a purchase, this is a sale, this is a purchase. Question. On our losing sale, we have a losing sale here, right? 30,000. Is there a 30 days before or 30 days after wash sale transaction? Yes, that is on January 20. So after sale, meron tayong papasok na purchase transaction on January 20. So sir, what is the rule then on that wash sale? If there is a full replacement, the amount of loss is added to the cost of replacement shares. Okay. So here, again, we have a loss of 30,000, right? So on January 20, let's assume January 20, what will happen on January 20? Let's assume you will purchase 15,000 shares for 8. That is equal to 120K, right? 15,000 for 8 pesos per share, 120K. And we have a loss on wash sale. What will happen to the loss? The loss is added to the cost of replacement shares. So therefore, the 15,000 shares now, the cost is equal to the original cost of 120 plus the amount of loss on wash sale amounting to 30K. So the total cost of the shares now is 150,000. That is if there's a full replacement. What is the full replacement? May 10,000 kang binenta kasi. Pag may replacement ka more than or equal to 10K, that is full replacement. If less than the 10K, that is considered partial replacement. So let's go on your partial replacement. So assuming you only purchase on January 20 7,000 shares for 8 pesos per share. 7,000 shares for 8 pesos per share. How much is that? 56K. 56K. So what will happen now on the 30,000 loss? For the 30,000 loss, there will be a deductible loss and there will be an added to the cost. What is the deductible loss? Only the proportion of unreplaced shares. Again, we have 10,000 losing shares, right? We replace 7,000 because yun yung binili natin. So in short, there is 3,000 na unreplaced shares. So to get the proportion, 3,000 all over 10,000 multiplied by the loss. So we have here 3 over 10 all over, 3 over 10 times 30,000. We have here deductible loss of 9,000. Okay? But this deductible loss will be subject to the rules of your capital losses. Will be subject to the rules of your capital loss. How about what will be added to the cost? That is on the proportion of the shares replaced. So we replace, sabi natin, 7,000 shares ang replace natin. So 7 all over 10 times 30,000, we will add 21,000. So what is now the cost? So the cost is that the original cost of the purchase was 56K, tama? And then we add for the cost on the loss on wash sale amounting to 21,000. So the cost of the new 7,000 shares will be now 77,000. Right? 77,000. Next, what if there's no replacement? If there's no replacement, then it will be treated as a deductible loss. What is that deductible loss? Again, will be based on the rule on your capital losses. Will be based on the rule of your capital losses. Again, what is a wash sale rule? You first determine if there's a losing sale. What is a losing sale? If ever the selling price is less than the cost. In our sample, the selling price, we sold it for 70,000. The cost was 100,000. So it is a losing sale. After you determine that there's a losing sale, the next thing that you need to determine if ever there is a purchase within 30 days before or 30 days after the losing sale. So in short, if our losing sale is January 15, right? Losing sale is January 15. Any purchase 30 days before or 30 days after, then we consider that as part of our wash sales rule. Then, how do we treat it? You determine if ever the purchase made within 30 days before or 30 days after is a full replacement, a partial replacement, or a no replacement. If that is full replacement, you add it to the cost of the replacement shares. If partial replacement, there is a deductible loss and something or a portion also added on the cost. So in our deductible loss is the proportion of unreplaced shares. So in our example, 10,000 yung binenta, di ba? Tas 7,000 lang yung binili uli. So we will only add a loss amounting to the unreplaced, which is 10 less 7K, so 3,000 shares. How about what is added to the cost on the shares replaced? So since we replace 7,000 shares, 7 all over 10 multiplied by the loss. If there's no replacement, take note, it can be a deductible loss as a capital loss. As a capital loss. Okay? That is the rule on your wash sales. Why is it important for us to know the wash sales rule? Because wash sales rule determine the cost of the shares sold. Okay? Cost of the shares sold or the tax basis. So if ever there is a wash sale, ingatan nyo lang, mag-iiba yung cost nung shares na binili mo or ibebenta mo. Katulad dito, naging 150K or naging 77K. Okay? That is for your wash sales. Now, how do we comply on the sale of your stock directly to buyer? So we have here your BIR Form 1707 and 1707A. As I told you earlier, the rule is that it is transactional or annual. So transactional, you file using 1707. For annual, you file 1707A. The transactional is still 30 days after each sale. The annual is 15th day of the fourth month following the close of the taxable year. So assuming the close is December 31, the fourth month is April, and the 15th day, so ang sagot natin ay April 15. Now, sir, question, what will happen on your transactional? We said that we need to get the net gain. So how do we get for the net gain? Selling price less the total cost, right? So what if it is a loss? What if it is a loss? If it is a loss, just file Form 1707. Just file Form 1707. But there will be no tax due. There will be no tax due. So what will happen is you will carry it over at the next gain transaction. Next gain transaction. Okay, so let's say for example, on January, you have a gain of 150K. On February, you have a loss of 20,000. On March, you have another gain of 80,000. So on January, you will file, right? So 150,000 gain multiplied by 15%, you need to file that. 150 times 15, that is 22,500. How about on February? You still need to file, but there is no tax due, zero. How about in your March? We said you can carry over the loss previously on your next gain transaction. So in net mo na to, magiging 60,000. So you need to file 60K. No, you need to file 60K multiplied by 15%. 60,000 multiplied by 15%. So we have here 9,000. Ganun pagka may loss. Ulitin natin. Pagka transactional siya, sorry, for transactional, you need to report always and just file 1707, whether there's a gain or loss. If there's a gain, then you compute 15%. If there's a loss, there will be no tax due. Just file zero. And ultimately, if there's another gain, you can just offset it or carry it over on the next gain transaction. So if there's a loss of 20 less 80, then we have here 60,000. And then on annual, let's say wala na siyang gain transaction after, we have here total gain or loss. So our total will be 150 less 20 plus 80. So this will give us 210,000. 210,000 multiplied by 15%. So this is the total. 210 times 15% will give us 31,500. So what will happen is that this is the total tax due less the taxes paid previously of 22,500 and 9,000. Ultimately, there is no tax due for annualized. Why? Because it is proportionate. It is proportionate. And since it is proportionate, whatever is the tax due before, you already paid it. So in your annualized, what you will only do is to report the total sale of stocks directly to buyer for the whole year. So take note, if there's a loss, you can carry it over. Sir, what if it is net loss? Okay, so for example, January, there's a gain of 150. On March, you have a loss of 200. And then August, you have additional loss of 100. So it is total net loss. So total net loss of 150K. What will happen to the tax paid here? Because you will pay here, right? Here you will not pay, zero. Here you will not pay. What will happen to the tax paid here? again, you can carry over the payment for next year. Or if you want, you can do the process of refund. But per practice, you don't refund as a whole. You better carry it over, especially if that is a stock directly to buyer and you normally see that you you normally sell stock directly to buyer, then properly just carry it over for next year if ever it is total net loss instead of net gain. Okay? So that's how we comply on your stock directly to buyer.